Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Hey, Kirk. Happy Friday to you again. We're on schedule for once, not moving it around, and it's just good to be in a routine.
Happy Friday. Yep,
Happy Friday.
it's a good week. Feels like fall. We had some 80-degree weather, which felt like summer, and all of a sudden last night it went down to 32 degrees. I turned on my chili pad bed, and it was too hot, and it was a kind of a mess. So, but
I'm going to be camping in 38 degrees tonight.
Good for you.
Let's go. Right on the North Shore, rock and roll. It prompted me to go out and get some down booties. The last time I did this, my feet got a little nippy, so now I'm gonna. It ain't about style; it's about function. I'm trying to make a style out of it, but give me function over style any day. I'm 50 years old now. I don't care.
Aren't booties for like babies? Like you have small feet, or what's going on?
Listen, they're big booties, but let me tell you, I felt like a little bit of a baby at 3 a.m. when we were camping in the middle of a fog and it was 40 degrees. So yes, I was a big baby, so those booties are my way.
Small feet smell like cabbage.
Yeah, exactly. Yeah, so it's down, so it's non-washable. So after a couple of campouts, this thing's gonna be ripe.
Oh, it's gonna be beautiful.
I love it.
Nice. Well, it's an interesting week. So I'm glad it's TGIF. Glad it's Friday here. A lot going on. Want to share a bunch of stuff with everybody here. We've been talking about a lot of different areas in the market for the last few weeks, for the last few months actually, on how precious metals have been doing really well. And another aspect is a bunch of markets broke out of either all-time highs or resistance levels this week, and now it's Friday, and it looks like they're giving it all back. So that's actually not a great sign. Usually, from a technical perspective, if there's a breakout, you want to see that breakout to continue. You don't want to see it break below. If you break below, you're in trouble. So I would say, be cautious at this point. If you're, I know a lot of people are over leveraged and overextended. September was a gangbuster month where people made a lot of money, and a lot of people got over their skis. I've talked to a lot of people this week actually who were telling me like, yeah, I had this big position on, and they're really excited about it. And I'm like, September, October is usually a rough period in there somewhere, a week or two. We might be starting that. It is earnings season, so we'll see how that goes. But I'd pull back. We already pulled back some of our positions. We probably should have pulled back more. But I think in periods like this, you just want to be super careful, because there's nothing like a all-time high breakout and then a breakdown to really sour your lunch. So I'd be more cautious here. People made a lot of gains over the last month and a half. Now would be a really good time to not be over your skis. So I want to discuss a few markets. We certainly have like end of the quarter numbers. I wanted to share some of those. But we had some charts last week, and there was one of them I wanted to touch on. I'm just going to cherry pick some of these because I think these are really important. So if I look here, we've been talking about gold, silver, and the mining stocks, right? We talked about the progression. Any sort of bull move in precious metals, it starts with gold, then hits silver, and then the miners, and then the junior miners. So we saw gold has been just in takeoff mode for a while now, which is great. And you never really know what is attributed to the gold price. I know you're going to listen to many people who are super smart, probably know more about the space than I do. And they're going to give you all the 6 ways from Sunday, the reasons why gold is going higher. And I can tell you, none of them are right. And all of them are right at the same time. We don't know what the reason is. Right. And I'm going to go back to this because I mentioned this a few weeks ago. Human beings need a reason. If we don't have an answer, it's like a void in our mind and it makes us crazy. We need an answer. if you think about, myths and religion, a lot of it came about because people were scared about death. Like, what happens after death? I don't know. That's scary, right? And so we fill the void with reason. And it's not attributed to religion necessarily, but like any void, like, oh, why is the sun going across the sky? Well, it's because a chariot is driving the sun across the sky every day. What? Well, where's the chariot? Oh, you can't see it because Zeus is pulling it. Like, we always come up with reasons. In science, it's the same thing, right? You come up with a reason. Doesn't mean it's right. It just means it's a reason because we can't have a void. In our mind, there has to be a reason, even if it's wrong. So we don't know why gold's going up, just like we don't know why it goes down. I can tell you the factors that lead to gold going up. And one of the big ones is central banks are buying gold. Central banks are buying gold. They are big buyers of gold and have been for a while. I would not say that's driving the gold price higher necessarily, but it's certainly contributing to it. They've been consistently buying gold right along. Now, there are some big buyers that are pushing the price higher. I don't know who they are, but someone behind the scenes or someone's are buying a lot of gold and pushing the price higher. Now, if I look at this correctly, and I've heard some rumors that there is some behind the scenes stuff going on in the Trump camp, meaning that there might be a stable coin backed by gold. Not saying it's true, but there's a rumor going around that that's happening. Now, if that's happening, that could contribute to the higher price of gold. That I would say could push it higher because they're bunching all together. It's going to be backed by a stable coin. I'm not saying this is true. I'm just saying there's a rumor I heard by some smart people who know people, and it makes sense. So the reason I have this chart up here, the gold miners to gold ratio, is because there's something you need to understand about the miners. Now, gold has been going higher, but miners haven't really picked up until recently. Why? Shouldn't they be going higher because gold's going higher? In part, that's part of it. But here's the other part. Miners are basically a play on the spread between the price of gold and the price of energy, the price of oil. Because you take oil as an input, and that creates an output of gold, right? They use the oil, put gas in the machines, they crank them up, pull out the gold, and you get the gold as an output. So it's basically a energy to gold input output ratio. So the price of oil is low, and the price of gold is increasing. So you've got this widening spread, which means miners should be doing better and better. Now, if you look at this miner to gold ratio, this in part attributes to this, but also it attributes to the fact that the miners are generally, not favorable right now. But they've just broken out. So this is a technical thing. I just once in a while like to look at these things. I think they're helpful, but it's something that you should be aware of. Now, let's see. Where's my other? Okay, here's another one I saw. I can't remember if I talked about. Did we talked about this last week, Doug? The mutual fund survey of how many people own gold.
No? I'm thinking maybe a little bit. Yeah, go ahead.
I'm going to mention it again, and then a few others. So one of the things to realize is that no one owns gold. Like fund managers, institutions, they don't own it for many reasons. Some of them it's because they have a mandate not to. And some of them they just don't believe in it. But at some point, people are going to wake up. Apparently, enough people are getting ahead of it, and so even a day like today, where most of the markets are down, gold's still up. There's a large push for owners of gold. I think right now, gold's up 40% this year. Silver's up a lot more than that. But I think what's important to recognize. Oh, here's another one. The global reserves of gold. There's something to keep in mind after the global financial crisis, everyone was buying gold. And these are reserves from like central banks and countries. US has not gone up, but every other country of note is. And in part, they're doing it more now because the US government decided to take Russian assets. So no one trusts the government anymore. The other countries don't. So like, yeah, we'll just put our money in gold instead of your treasuries. So we kind of shot ourselves in the foot on that one. But we are a very low percentage of global equities. I think the mining industry is a low percentage of global equities. It's like 1%. It's really low. It should be higher.
Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today.
I want to jump back because I actually had something that I put in this, which was talking about the look of gold in especially with regards to where is it? Sorry, you were all over the place. We were actually looking forward to the perception. Yeah. So one of the things I wanted to kind of take a look at is when we consider the impact of what's going on, and we've talked about this. It's, the dollar is not necessarily 100% correlated to why we're getting a rise in the value of these types of commodities, but the perception, part of the perception is we are, again, Kirk's talking about, we don't know if it's necessarily these treasuries that are buying up, although that's going to certainly be a supply demand pressure. But at the same time, there has been a decline in the value of the dollar, which of course makes things typically more expensive. So we're starting to see that another area that not just silver, but also silver and gold, but also lead is something that is going up. I mean, again, because that goes into a lot of uses, and ultimately we're starting to see quite a few things become appreciated. Buffett had a really good thing. I want to say, talk about gold too, and again, where we're at, in his philosophy, it's a great indicator of fear. And I think, if we're seeing this gold go up and constantly people going into it, that means that underlying there is a little bit of a level of fear there. What is the fear? Well, predominantly what you're seeing out there is, of course, the purchasing power of the dollar, and ultimately concerns over fiat, which you've seen kind of driving up in Bitcoin and other places. But I want to read this quote. What motivates most gold purchasers is their belief that the ranks of the fearful will grow. During the past decade, that belief has proved correct. And beyond that, the rising price has on its own generated additional buying enthusiasm, attracting purchasers who see the rise as validating an investment thesis. As bandwagon investors join the party, they create their own truth for a while. This is his 2011 letter to shareholders. Now we are, remember what Kirk was talking about. You want to be ahead of a trend, right? Eventually, when everybody else jumps in, that trend is gone. And so, whereas gold gives an opportunity here, that is a way of going long on fear. I'm continuing this quote. It's been pretty good way of going long on fear from time to time. But you also have to hope that people become more afraid in the year or 2 years than they are now. And if they become more afraid, well, guess what? You make money. And if they become less afraid, you lose money. The gold itself, it's not necessarily, it's always going to be an indicator of that, of not necessarily of production. It gets dug out of the ground, we melt it down, we dig another hole, we bury it again, pay people to stand around guarding it. In his opinion, had no utility. Watching from Mars, people would be scratching their head. I like that quote from him. And the reality is it's not useful, but it is, but through centuries, and we're seeing it again, it is one of the key areas that has consistently been an area in which people have gone back to a tangible holding when uncertainty in other areas, especially when you look at government-backed currency, you wonder what's going on with policy. You look at the fact that we left the gold standard, 50 years ago. All of that adding up to a situation where you look at the massive amounts of debt around the country. And one thing I did also get a nice chart on is that we are sitting in a historical anomaly right now, whereas typically you're going to see in most circumstances a big gold, a big gold gain. You're going to see gold go down. Oil's typically it often will go up, or gold and oil will both go up. And then or gold and oil will go down. We're in a situation that if we take a look at the gold price and how much it's up, which is roughly 70%, okay, and we take a look at oil price year to year, which currently is hovering down around 20%. We have never been in this type of a ratio between gold and oil, at least going back to, looking at Bank of America put this together. And if we chart everything else, the only other real significant anomalies that we saw that came close, Kirk, interestingly enough, was the opposite, where gold and oil both went up at the same time. And that at an extreme level. And that was 1973, 1974, and 1979. By the way, that is considered to be the stagflation eras, which during that period of time of stagflation, which this ties me into another thing I want to go into as a tangent, stagflation was from about the mid 70s through the mid 80s. And at that time, the S&P 500 averaged about a 0.8% annualized rate of return. Okay. Now, that doesn't mean we didn't have good years, but we had good years tempered by bad years that brought it back down. Kind of like 2000 to 2010, considered flat. Doesn't mean we didn't have good runs between 2002 and 2007. Doesn't mean we didn't have good runs between, say, 2008, 2009, and 2010. But unfortunately, extreme volatility. So all of those times, though, in the 70s, we had gold and oil all go up. Now, we have 2025 is the only time where the data points for gold is equal to the 70s. But interesting enough, oil is actually negative. We have never seen it to that level of extreme, at least in the charting that Bank of America Global Investment Strategy is putting together. We've seen many more circumstances, although nowhere near as extreme, to where gold and oil both went down, or gold went down while oil went up. So again, what does this mean? It definitely means we are sitting in an anomaly, and it tells you, maybe, Warren may be correct in the one aspect that he's saying is that gold is an indicator of fear, and there is potentially a fear that's laying out there that's causing, whether or not it is, it could be backed by a stable coin, but it could also be backed, we've seen it in the treasuries, that they are, and we also knew a couple of years ago that going against the dollar as the world currency against oil could have exacerbated this rise in treasuries to focus on going back to gold. By the way, I did the tangent that I wanted to talk about, and this kind of comes back to a stagflation era kind of conversation. But I had a conversation with someone the other day who was talking to me, of course, very excited about how well the stock market had done recently over the last couple of years. The last 2 years, 25 ish percent. And we've had a really phenomenal run, sans 2023 since the end of COVID. We've talked about this ad nauseum, lots of money injected in the markets. Well, it's forced a lot of people and a lot of half-truth advice, and even Warren Buffett has said this, that everybody should be buying the S&P 500. And why should I own anything other than the S&P 500? It's a common question investors had asked at the beginning of this year. It's a common question that's been asked for many years. The common advice given by many people out there. Well, this year, we are starting to see one of those reasons, right? We've seen stocks; they're still doing well. U.S. stocks up, at least at the time of the chart that I was looking at, which was October 6th, so 4 days ago. U.S. stocks in the S&P 500 total return up about 15.3% for the year. Now, next to that, let's look at European stocks and the MSCI Europe total return up 31%. Emerging market stocks, the MSCI emerging markets total return up 30.1. So this is again an indicator that, you know, having all your eggs in one basket, 15% isn't bad, but it's certainly, you know, a reminder that you need to be able to be flexible and fluid and know and look at changing where you're investing. One size does not fit all. I'm bringing that up again as we're talking about gold because, again, as we've said about being ahead of the curve, if you're just sitting in the S&P 500 right now, and again, who knows what those you know, current profit reports are going to come out as. But if we miss on them, and we're always seeing the last couple of days, a little bit of a pullback here, probably computer trading, getting ready for these profit reports. That's just how the markets run these days. But you're going to, you know, we could see a time in which less confidence in S&P, less confidence in U.S. stocks. Again, money's going to go somewhere else. And we're already starting to see that in areas like commodities. The other thing I want to talk about going back to lastly on the longer secular trend, but if we go back to the stagflation area, that 10 years of the return of the S&P being about 0.8 per year, again, go back to 2000 to 2010, where it was effectively flat. A reminder that, you know, we can go through significant periods in which performance in the markets does not meet the you know, the rhetoric that you hear right now that it's just the only place to be. In fact, it's interesting, but I've got some data. I have a chart on this, whether we'll show it or not. But if you right now, banks are paying about 4.5 to 5%. Okay. Now that feels really good. No, I say banks, I'm talking about some higher yielding ones out there. Your big banks are still screwing you left and right. But if you can go out and get 4.5 to 5%, although that's dipped back since they've lowered interest rates, most people would consider that relatively good for now. Historically, still pretty poor, and especially when you look at, you know, inflation on the price of needs like food, utilities, etc., spiking pretty rapidly and being arguably at that level or more. It's not really making you any money. But here's the thing. That 5% actually historically doesn't look too bad. I know we get all caught up on these 20% returns and gold and S&P, but from 2000 to 2025, the S&P 500 has averaged right around 9.5% annualized growth. Now that's an average, and I want to key on this for a second, that there's a difference between average and actual. Average is you just take the annual return divided by the number of years. Looks great. That's not what you're getting. The actual return over that 25 years is actually about 1.5% less per year. It's closer to about 8%. And that is because of something that you have to be aware of in planning called sequence of returns. And it's what are you receiving and when are you getting that return, and also the impact of having to make up for losses. And it becomes a very important variable, especially if you're transitioning into retirement. You have to be focused on this because it will significantly or could significantly impact whether or not your retirement will be successful. Because of the sequence of returns, though, like I said, 1.5% less than the average. So when you hear about average returns, understand that's a half truth, and it doesn't mean that's what you're getting. It also assumes you're putting everything in the S&P 500. But here's the reality. The majority of that growth of the S&P 500 has been since about 2019, 2020. If we extract that out, the S&P 500 did not hit 5% annualized until 2018. That's 18 years in which the S&P 500's actual return was less than you can get in a money market account right now. So that's the impact of volatility. That's the impact of sequence of returns. And that is the impact of doing the same thing over and over and never changing with the wind.
Yeah. I want to kind of pivot a little bit because I found these charts and I thought they were pretty interesting. I mean, these are the electricity price increases since 2020. And I bring this up for a few reasons, but as you can see here, it ranges from Nevada's close to zero, and you have California close to 64% or 67% in Maine. Um, most of the countries in the 30-40% range. That's a lot. That's a lot for people whose wages haven't increased, and all the goods and services have increased. Um, it's in some ways it's not a lot because the CPI has, I think, after COVID in a few years, it was up like 23%. So I'd say 30% is probably, according to the CPI, what it's up in the last 5 years. But we all know it's not 30%. It took a year and a half and my food went up like 100%. Um, all of our prices went up across the board. So I kind of show this because depending on your state, it might be more or less impacting you. Mine's only 21%, but it feels like a lot more than that. Here's the problem is that even though all that's happening, and I want to show you one more chart.
Can I interject since you show that? I have another chart on the electricity that I put in there.
Yeah, I was going to.
Okay, good. I want to make sure you show that one.
Yeah. So this is the average price, but it just kind of shows that it's skyrocketing. Now, I want to kind of point this out because people don't really talk about this. Everyone's excited about AI. Everyone's excited about, oh, it's going to be great, or the world's going to end, whatever you think is about AI. The reality is AI is an energy hog. We do not have enough energy for it. So if you kind of play this out, right? AI has exponentially been increasing. And its energy need has also been increasing. Well, here's what's interesting. We don't have the capacity for AI to increase exponentially. We just don't. We're already kind of at capacity, so much so that I think it was Microsoft decided to pay twice the price for nuclear energy than you would get on the spot market just so they could have access to it. The fact that all of these companies are just sucking in all the energy. Well, what are going to be the consequences? And we all think, well, that's great. It'll be AI and it'll make the energy, make the world better. Well, let's talk about consequences. Now, what are the consequences? We go back to supply and demand, basic econ 101. What happens when you have a lot of supply of something? Prices go down. What happens when you have a lot of demand for it? And you don't have equal supply, but increasing demand, prices go up. So we have this big increase of demand, which is the equivalent of a big increase in price to accommodate the big increase in demand. So what's going to happen? You're going to be spending a lot more on electricity, and there's probably going to be brownouts or blackouts, assuming that things don't break in the process because of the huge need. So I'm wondering, why are we subsidizing the AI companies? Because effectively that's the result. Now, I'm a free market capitalist, but when you have AI companies basically sucking up all the energy, who's going to pay for it? We are, all of us. And if energy goes up twice from here because AI is coming online, we're paying for that. Yeah, they're paying for it too, but we're paying for it because a combination of our government and energy companies have had their heads up their butt for the last 40 years in not bringing online nuclear. Now, part of that's the energy companies, in my opinion. Some of this I can't prove, but the energy companies have stymied nuclear energy. Now, part of that is the public sentiment, but it's not just that. A lot of us are afraid of nuclear, but that originated from a certain place, and I would say that's probably not organic. But the point is we're behind. We're 10 to 20 years behind in our energy needs and our ability to ramp it up. So unless Trump puts an Operation Warp Speed to get nuclear energy online quickly, and even then, I'm not saying that could happen because a lot has to happen to make sure it's done right, make sure it's safe. Lots of things going on, and people are just starting to do that. So at some point in time, there's going to be a huge demand. We'll see where that goes. I'm super bullish on nuclear, on the sector, on the miners, anything related to it. hard sector to invest in, but we're going to have a lot of energy needs, and we're going to be subsidizing it until all that comes online. So if you're voting against nuclear, then I don't like you very much, because if you're one of these people that thinks, well, we should submarine all the carbon because we want to make the planet green, I don't like you very much, because me, you, everyone else's energy prices are going to go up because we've had a very poor energy policy in this country for decades. It's nothing new. It's not a recent thing. It's for decades. We've had a very bad energy policy in this country. We have no insight or no foresight for what could come down the road. How about the fact that our electricity infrastructure is horrendous? It's like a D, ranks a D, which means that not only could things randomly break and one little squirrel could put the power out for the whole Northeast corridor all the way up to Canada, because our system was designed so poorly that can happen. So if you think of things like this, why are we not prioritizing this? Well, the only reason that nuclear is even being talked about is because Silicon Valley deems it to be. They're putting money to lobbyists to make sure that we push the nuclear energy narrative. I mentioned it in this show like a year ago. Where did all the narrative go about clean energy? It just disappeared altogether. So any of you who wonder, most of you don't wonder this, but I do because I'm weird. But if you ever wonder, like, why is everybody saying the same thing? Why are all the news stations having the same talking points? Why do they all sound the same? It's because they all have a big script. They all share the same script. I don't know how they do it, but I know they get the same script because you can record them. They say literally the same words in a different order, but basically the same words, same. It's crazy. So what I noticed about a year ago was the clean energy movement that had been pushing people for years disappeared. Nowhere. No one was talking about it for like a month. Not a word. And then all of a sudden, month and a half later, Joe Biden came out and said, hey, we're going to push nuclear. We're going to make it easier to get regulatory approval. Really? Okay. Just out of the blue? Like, Joe Biden wasn't exactly mentally sharp at that stage, so I'm sure it wasn't him. But somebody in the White House decided that was a thing. And so I bring this up because narratives make me laugh, that the fact that so many people have them and that people don't realize that they're being lied to and they're being manipulated. Is that when they give you the narrative, like this is important or this is not important, people say, yeah, you're right. Well, what about the dog that didn't bark, right? What about nuclear? It's been clean for a long time. Why are they bringing it out now? Because they have to, because they don't have any choice. They know it's clean. They know it's great. They know it's all of the things that we've been looking for. And all of a sudden people are talking about it because, well, we don't have a choice. What's the phrase? America's great at doing the right thing after it's exhausted all those other options. I think that's just the truth of it. So point being is you just have to be careful about what you're being fed. I'm going to keep it short because we got 10 minutes here. I want to run through two more charts. But I think it's really important to keep in mind, like, we're all paying for this stuff. So you should be, if you're at all political or if you're all one of these people that stand outside and picket, you should be pushing nuclear. You really should, because we're all going to get screwed after this. So I want to point out a few more charts and I'll hand it back to Doug. So this is great. I don't really follow Peter, but somebody sent me this chart. I'm like, all right, this is something good. So for a long time, the U.S. has been the place to invest. Long time. For 15, 17 years, it's the only place to be. It's the best performing country in the world, except for this year. This year, it's only up 15% as of I don't know when this is, as of October 6th, up 15.3%. You know what else is up? European stocks up 31%, double that. Emerging market stocks is up almost 31%, double that. Everything is doing better in the U.S. this year. The only reason that people haven't noticed is because the U.S. is up 15% and no one's bothered to say, I feel good about that. they haven't bothered to say, oh, I wonder what the rest of the world's doing. Oh, it's doing a heck of a lot better than we are. Everywhere is doing better than we are, virtually everywhere. So I would just be mindful of the fact that global money flows tend to shift in 10-year increments. The 90s was international, the 2000s with the US. You think the 10s would have been international, but it wasn't. So it's kind of like it kept going US. But this could be a turning point where international is better. So all of you thought like MAGA was going to be pro-US. It actually isn't. This is where logic kind of defies the markets. You think, well, Trump with all his tariffs, everyone's going to get screwed, and the U.S. will be the best place to be. Nope, it's not what happened. It's the exact opposite. Everywhere else is the best place to be. So just something to keep in mind. Always keep your eyes open of what's working, what isn't. I think that was the last chart. Oh, one more chart here. So I've seen this being bandied around, and I only mention it just because we see so much chart crime that I just wanted to share chart crime with you before we get back to Doug. Here's the .com boom overlaid with the AI boom. So it's basically from 95 to late to 90, actually January of 98. And it's from 2023 until basically today. So it's similar compared. I mean, the time frame's similar at least. And it looks really similar. It looks like the chart's kind of almost a perfect overlay. I'd say in the correlation category, it's probably in the 90s, I would guess. It looks a lot like it. So what do we take away from this? I'll tell you, nothing. Don't take anything away from this. I'm only bringing this up to show you what a chart crime looks like. This is what we call ratios or relationships. So a lot of people do this in Wall Street, and I'm not saying it's wrong. I mean, it's basically you're looking at probabilities in history and saying, well, if I'm dipping the odds and they're 50-50, maybe it's 55-45 because there's some similarities here. Don't draw any conclusions. This is a narrative. This is a narrative to say, hey, we're in an AI boom, it's going to bust. Although this is 98, so we get 2 more years according to this. But I'm not saying it's going to bust right now, but booms do turn to bust. So just be careful. I don't know if this is accurate or not. I'd be thrilled if it was, because that means we get 2 more years of crazy returns. But I haven't seen any pet.coms yet, so I'm pretty sure we're safe. I think it's similar to the tech boom because tech companies didn't make any money, and AI companies are basically commodities that won't make any money too. I'm not sure how they can make money. So I do have this voice in the back of my head, which the rational one anyway, that's telling me that AI could be a farce. I was talking to an engineer this week, and he gave me an interesting insight. He's like, yeah, how does everybody not know this? Like everyone just knows this is machine learning. It's not AI. Like everyone thinks it's AI. It's not. It's just machine learning. We've been doing this for decades. It's like nothing new. And I was like, okay, that just puts it back in the okay, people are overblowing this camp. So just something to think about when you're trying to overdo it on AI and overspend on companies like have PE of 100. Just be careful. All it takes is the boom to turn around, and you're going to lose a lot of money. So don't get greedy. Manage your risk. Do it right. If you're going to take a bet, that's fine. Just make sure that you can afford to lose. So when you're investing, use first principles when you're doing so. You want to wrap us up here, Doug?
Yeah. So I got a couple things I thought were kind of fun to tie into this too. So couple of the other charts that are on there, I think that I thought were interesting. Since you're talking about AI, this is kind of funny. There was an announcement that caused almost dead man walking AMD, and in this world that we're in right now, NVIDIA has been the darling of chips. It's pretty much killed off Intel. AMD has been close to that too. Well, they announced this wonderful strategic partnership earlier in the week, caused AMD stock to spike. So if you want to share this, I can read it to you. I think it's really, really funny because, as you just said, what's AI going to be? I don't know. But how did there's a really funny summary of this deal. How do these negotiations go? Like schematically, OpenAI. Well, we would like 6 gigawatts worth of your chips do inference. AMD, terrific. That'll be $78 billion. How would you like to pay? Well, we were thinking that we would announce the deal, and that would add $78 billion of value of your company, which should cover it. AMD, silence. OpenAI, silence. In negotiation, the person that talks first loses, and then AMD talks. No, I'm pretty sure you have to pay for the chips. Why? I don't know. It just seems wrong not to. Okay, well, why don't we pay you cash for the value of the chips and you give us back the stock, and then we'll announce the deal and the stock go up and we'll get our $78 billion back. Yeah, I guess that works, though. I feel we should get some of the deal. Okay, you can have half. You give us stock worth like $35 billion and you get to keep the rest. And I was watching this. There's another one I saw. Somebody did a chart where basically it showed you if you push the deal with NVIDIA, then push the deal with AMD. I mean, I'm not saying there was a guy named Charles that felt like he was, that had this really wonderful system that kept all these valuations propped up until people actually needed their money. But Charles might have been onto AI long before AI. If anybody knows the Charles I'm talking about.
Talking about Mr. Ponzi?
Mr. Ponzi might have just had a few thoughts on this. So it is definitely, I'm not saying there isn't much money out there right now, but literally the announcement and the discussion and the excitement of AI is driving the majority of what is the booming increase and growth of AI. CEOs and CIOs are consistently coming out and talking about how they can't figure out how to turn this into anything that makes money. And we saw this in the dot-coms, like, oh, how's the internet? We're not making money. They saw the future of the internet. They knew that adding technology to a world that was extremely modernized or extremely manual was going to make things faster than it is. But, with AI, you're talking about, who do you think pays for not only the purchase of these chips, the purchase of these servers, and the electricity to run them is astronomical for these companies. And what is it still being done? Oh, we already have the internet, and AI is right now functioning as a glorified internet. It's a glorified search engine for the most things. Yes, it can do some things faster, but ultimately, and that will replace some areas. But right now, companies themselves are struggling to figure out how to turn this into something that is going to be profitable. And if that doesn't happen, and it can't become more accurate, which is the other thing. With the internet, you did your own research and deciphered it. With AI, you literally put it in and people go with what it tells them. And there's a ton of erroneous information that is built, unfortunately, on information that we put in, garbage out still exists very heavily. So we'll see what happens there. Another one I wanted to throw up here, I always think is really fun because, we like to talk about correlations and causation. And every once in a while, it is always enjoyable to go back to the well of spurious correlations. And so I popped a couple in there, but I looked at, did you know, Kirk, that the price of gold, it's correlated to the purchase of processed vegetables and on fresh fruits in the household?
I did not know that, Doug. That's useful information.
And actually, this is better than some of the charts that we've actually seen, because this one goes all the way back to the year 2000, that the spending on processed vegetables and gold have both risen lockstep until, well, I guess the chart ended in around 2013, 2014. So at some point there was a disconnect between those two things that's now led gold, I'm going to do what most chart crimes do, Kirk, and I'm going to say that based on the trend line here, the price of gold is actually going to continue to go down from 2014, that this was the start of it, and that the future of gold is probably going to zero, because you could probably draw a line off that red line to zero, right? That's how chart crimes work. And we see these all the time where someone will take this data of 2014 and just draw, well, look, price of food is going up. Gold, we see the trend, here it goes again. And I think that obviously lines into, overlays what you were just talking about. I know we were, wrapping up here on time a little bit. So I've got a couple other fun things that I was going to get into, but I will save those until next week. And I will just basically, decide to end with this. The markets are going to change. We've seen that the S&P 500 is not the best asset class to be in right now. There's been significant periods where it has been one of the worst asset classes. The trends are going to shift. And what worked last decade might not be what leads the next. And that's why smart strategies focus on structure, not speculation. If you're ready to protect your future with compounding, consistency, and control, then you can get some information from us on how you can protect your wealth. Visit us at mergentcollegeadvisors.com, MERGENT, mergentcollegeadvisors.com. Just an FYI, we're going to be coming out with a new updating our website for mergentadvisors.net and mergentcollegeadvisors.com very shortly. So you're going to see some really new things on there. So go check that out. It's not up yet, but hopefully in the next couple of weeks. We're educating families. We're empowering futures. And we are going to help you build wealth with structure, not speculation.
Awesome, Doug. Well, appreciate you coming on the show.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.